By the end of this decade, India requires 500 gigawatts of deployed non-fossil infrastructure to meet its national energy targets. The Indian Renewable Energy Development Agency, or IREDA, operates as the central financial vehicle engineered to fund this massive infrastructure shift. Its core foundational advantage comes from its status as a Navratna public sector undertaking, fortified by a substantial 71.76% sovereign promoter stake. This organizational diagram illustrates the scale of the operation, breaking down an expanding loan book that currently exceeds 94,900 crore rupees. The deployed capital is distributed with 27% in solar, 18% in wind, 20% in hydro, and 35% allocated to emerging technologies. Despite managing nearly ₹1 trillion in capital, the institution operates with an ultra-lean structure, employing fewer than 200 people. By combining sovereign-backed, low-cost capital access with aggressive balance sheet protection, IREDA engineers a high-growth yield profile. This specific architecture allows the institution to command a significant valuation premium in the public markets over its legacy hybrid peers. To understand why institutional investors pay this premium, we have to systematically tear down the mechanics of its balance sheet from the ground up. We start by examining the liability side of the balance sheet to see how the institution mobilizes capital. Its sovereign backing provides access to domestic and multilateral debt avenues that private competitors cannot reach. This bilateral flow diagram maps the funding mix driving the balance sheet. 58% is sourced from bank term loans, 38% from taxable bonds, supplemented by specialized 54EC and multilateral streams. When blended together, these liability streams result in a competitive cost of funds at approximately 7.6%. On the asset deployment side, these funds are channeled into long-tenor green infrastructure projects that yield roughly 9.3%. The difference between the cost of funds and the yield creates a stable net interest margin spread that oscillates between 1.4 and 1.8%. Preserving that margin down to the bottom line requires significant operating leverage. Management achieves this by maintaining an ultra-lean cost-to-income ratio of just 14 to 16. Compounding a loan book at 26.5% annually introduces new credit risks associated with frontier technologies. Looking at this 3D bar chart, we can map the multi-year trajectory, observing the loan book doubling from FY23 to reach 94,936 crore rupees in the trailing 12 months. However, bottom-line profit growth experienced a moderation between FY26 and the first quarter of FY27. This moderation is a deliberate outcome of a strategic acceleration in credit provisioning on legacy hybrid accounts, rather than a sign of operational decay. The baseline risk metric that prompted this was a gross non-performing asset ratio of 3.76%. IREDA applied an aggressive provisioning strategy against those assets, bringing the net NPA down to 1.23%. Reducing the net NPA to this level helps insulate the broader balance sheet from potential contagion. This risk management is supported by a capital adequacy ratio of 20.30%, well above the regulatory baseline. This capital buffer is maintained alongside a manageable leverage position, with a debt-to-equity ratio of 5.59 times. By front-loading credit cost recognition, management sacrifices short-term profit optics to prioritize the long-term stability of its capital base. Looking ahead, growth is driven by India's projected deployment of over 30 lakh crore rupees in clean energy debt by 2030. This capital is required to fund utility-scale infrastructure deployment across the subcontinent. To facilitate this, the Gift City IFSC subsidiary acts as a critical node designed to enable direct foreign currency green lending. This offshore setup reduces domestic hedging friction, allowing international capital to flow directly into domestic projects. Based on this pipeline, management has set a target to expand the loan book to 1.5 lakh crore by FY28. This expansion targets high-margin categories, including battery storage, green hydrogen exports, and electric vehicle corridors. This comparison matrix clarifies why the market prices IREA differently from diversified power financiers like PFC and REC. IREA commands an approximately 17 times price-to-earnings multiple and 2.38 times price-to-book, while its peers trade near 7 times earnings. This premium is attributed to its zero-legacy thermal generation exposure, which grants it direct eligibility for global ESG mandates. However, investors must monitor a key risk factor, a 77% concentration exposure to private developers. Ultimately, this valuation premium reflects the price for an unencumbered, high-growth asset operating entirely within the green transition. Following a valuation de-rating from its historical peak, the stock is currently positioned for long-term compounders. This dashboard highlights an upcoming catalyst, a 2,994 crore QIP equity raise. The first critical metric to monitor is defending the net interest margin above 3.65%. Second, watch quarterly credit provisions normalized below 150 crore. Finally, ensure the gross NPA glide path resumes its trajectory below 3%. For capital allocators navigating energy infrastructure, IREDA stands as a pure-play compounding vehicle on India's green economic transition.